Why are economists so clueless? It's because the busy squirrels with economics degrees have only nut-pile notions of what money really is. Take this chart of the money supply provided by the U.S. Federal Reserve. The line M1 is cash, plus the total amount of money in checking accounts. M2 is M1 plus the total amount of money in savings accounts. Note that M2 is normally about 4 times M1. To economists, M2 is like the total amount of nuts in a pile, and M1 is that portion of the nuts being spent in active commerce. So where's the problem? But the reality is that almost all of this so-called money is actually bank credit, created as a scheduled promise to pay it back to a bank. The Bank of England confirmed this in 2014. Therefore, M2 is actually the total amount of principal debt to banks on which borrowers are making principal and interest payments. And M1 is the small portion of that debt money possibly available to be earned to make those payments. There's more. Banking practice allows banks to replace savings with new loans. Therefore, the only way M2 can be 4 times M1 is that every dollar created as M1 has been saved and replaced by banks 3 times over. Therefore, every dollar in M1 is owed as principal debt to a bank 4 times over. Try coming up with any other explanation. But don't try telling this to the pile of nuts economists. Their shell of professional ignorance won't crack, and one can readily understand why they can't admit the obvious. Their squirrely ideas have cost us all dearly.